In this video, we are going to talk about how would Warren Buffett invest a small amount of money. So before starting this video, please like this video and subscribe to our channel for future updates. Warren Buffett is a big name in the investing world. With a net worth of $114.2 billion, people are all ears when he's speaking. From picking small companies to not sweating it when your stock drops, here's Buffett's advice for investing $10,000 if you want to get rich. And if you want to learn how to save $10,000 in 1 to 5 years, stay tuned to the end of the video to learn how. Warren Buffett Brief History. Warren Buffett was born in Omaha in 1930. He developed an interest in the business world and in investing at an early age, including the stock market. Buffett started his education at the Wharton School at the University of Pennsylvania before moving to the University of Nebraska, where he received an undergraduate degree in business administration. He later went to the Columbia Business School, where he earned his graduate degree in economics. Buffett began his career as an investment salesperson in the early 1950s, and he formed Buffett Associates in 1956. He was in control of Berkshire Hathaway less than 10 years later in 1965. Buffett announced his plans to donate his entire fortune to charity in June 2006. He and Bill Gates then announced in 2010 that they had formed the Giving Pledge campaign to encourage other wealthy individuals to pursue philanthropy. Buffett's investment philosophy. Buffett follows the Benjamin Graham school of value investing. Value investors look for securities with prices that are unjustifiably low based on their intrinsic worth. There isn't a universally accepted method to determine intrinsic worth, but it's most often estimated by analyzing a company's fundamentals. A value investor searches for stocks that are believed to be undervalued by the market or that aren't recognized by the majority of other buyers. Buffett takes this value investing approach to another level. Many value investors don't support the efficient market hypothesis, EMH, a theory that suggests that stocks always trade at their fair value. This makes it harder for investors to buy stocks that are undervalued or to sell them at inflated prices. They do trust that the market will eventually start to favor those quality stocks that were undervalued for a time. Warren Buffett has continuously stressed the importance of investing in yourself as a means to success. This includes making prudent financial choices as well as increasing your knowledge in the areas in which you seek to take part. Buffett isn't concerned with the supply and demand intricacies of the stock market. He's not really concerned with the activities of the stock market at all. This is the implication in his famous paraphrase of a Benjamin Graham quote. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. He looks at each company as a whole, so he chooses stocks based solely on their overall potential as a company. Buffett doesn't seek capital gain by holding these stocks as a long-term play. He wants ownership in quality companies that are extremely capable of generating earnings. Buffett isn't concerned when he invests in it whether the market will eventually recognize a company's worth. He's concerned with how well that company can make money as a business. Buffett's investment tips. Buffett has shared his philosophies through some outstanding and thought-provoking tips over the years. Number 1. Wait, then pounce. Buffett advises taking a deep breath and a step back when you find a company in which you want to invest. He suggests giving the stock time to achieve a reasonable valuation, then moving when the market corrects. Number 2. Stay the course. So you've breathed, you've waited, and now it's time to move. Buffett suggests that you want to resist panicking at this point and selling your holdings when they falter, and at some point they will. Don't sell, buy. Just keep buying, he said in a CNBC interview. American business is going to do fine over time, so you know the investment universe is going to do very well. Number 3. Pick businesses, not stocks. Always weigh and analyze the business behind a stock. Try to focus on businesses you understand and of which you have some knowledge. This will help you assess where a company is going, not just where it's been, and where it is at present. Buffett once famously took passes on Google and Amazon because he admitted that he didn't possess firm knowledge of the internet industry, so he found it difficult to analyze its stock's fate. This tip goes hand in hand with having patience. Educate yourself if you spot an interesting opportunity in a field that you're not entirely familiar with. Analyze the balance sheets. Take time to learn. Another priceless Buffett advisory comment is that you should plan to own a stock for at least 10 years, if not longer. Keep in mind that a business will have time to evolve. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, he said in his 1996 letter to Berkshire Hathaway shareholders. Get started early. First and foremost, Buffett recommends getting started early when it comes to investing to take advantage of the power of compound interest. He describes the power of compound interest as building a little snowball and rolling it down a very long hill. As the snowball rolls down the hill, it collects more and more snow until it becomes a huge snowball. At an annual shareholders meeting, when someone asked him how they could make billions of dollars, Buffett said, "The trick is to have a very long hill, which means either starting very young or living to be very old." Invest in small companies. Buffett recommends investing in small companies. Large investors, like Buffett, and funds tend to place focus on larger companies, which means small business stocks will have less competition, allowing someone with $10,000 to find some hidden gems. Nevertheless, Buffett said the only way to multiply your money is to buy into good businesses by buying pieces of them, aka stocks, at attractive prices. Buffett said if he was just getting out of school and had $10,000 to invest, he'd begin by looking at companies that have names that start with A and continue down the list, focusing on smaller companies to find the ones he wanted to invest in. Don't worry about your stock going down. If you're going to do dumb things because your stock goes down, then you shouldn't own stock at all, said Buffett in an interview with CNBC. Dumb things, he clarified, are selling your stock just because the price goes down. Buffett said that it's inevitable that your stock will go down sometime, so why worry about it? The point is to buy something you like, at a price you like, and then hold it for 20 years, he said. Buffett said you shouldn't look at your stocks day to day. If you want a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month, he said. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down. Additional expert advice for investing $10,000 to get rich. Robert R. Johnson, Ph.D., CFA, Kalaya, professor of finance at Hyder College of Business, Creighton University, said, "The best investment strategy for most investors is to keep it simple, stupid, guess. People should invest in a low-fee, diversified equity index fund and continue to invest consistently whether the market is up, down, or sideways. Dollar cost averaging into an index mutual fund or ETF is a terrific lifelong strategy. Dollar cost averaging is a simple technique that entails investing a fixed amount of money in the same fund or stock at regular intervals over a long period of time. For the vast majority of investors, the KISS mantra, keep it simple, stupid, should guide their investment philosophy." Regarding Buffett, Johnson said, "Warren Buffett has created an empire by investing in boring state enterprises like See's Candies, Dairy Queen, and Nebraska Furniture Mart. These may not be sexy companies, but they perform well. Consistency and patience are the virtues associated with accumulating wealth over the long run." Jeff Bezos once asked Warren Buffett, "You are the second richest man in the world, and yet you have the simplest investment thesis. How come others didn't follow this?" To which Warren Buffett responded, "Because no one wants to get rich slowly." What Buffett is referring to here is his philosophy of investing in good companies and staying invested for the long run, letting compounding work its magic. So that's our video for today. If you liked or enjoyed it or found anything useful, don't forget to subscribe to our channel, hit that like button, and turn on bell notifications. And we'll be back with another interesting topic. Until then, stay safe and stay happy, and keep building and rolling your snowball. And if you want to learn how to save $10,000 in 1 to 5 years, click the next video on the screen.